Good afternoon, everybody. This is James with 77 Financial Group. You're listening to 15 Minutes of Finance, where in the next 15 minutes, I bet I can get you excited about investing. Let's do it. All right. Happy Sunday, everybody. We have a Sunday special for you, what to expect this week. And guys, my hands are folded. My fingers are crossed. My head is bowed. I am praying and begging for good inflation news. If rates drop at all, if we even get a hint of rates dropping, get ready, because that is, and usually, let me say it this way. Usually when rates drop, it's not really noticeable right away. Sometimes there's even a drop in the S&P 500 price point. Sometimes it's negative for a couple of days. And then the money comes in. Because guess what? When rates go down, it means it's easier to get money, which means it's easier to invest money, which means more money gets invested in equities. Okay? There's $7 trillion waiting on the sidelines to jump in. So that could be an absolute boom for the economy, for the market, for your stock portfolio, for the S&P 500 in general, for GDP, for everything. That could be incredible news. And so we're going to talk a little bit about that today. We'll talk about, let me just jump into it. We got the term of the day, which is a term I'm making up, okay? We're out here. We own a firm. We're doing stuff. You guys get to learn a term today by yours truly, and I'm calling it the 5410. Okay, the 5410 is incredibly important, and it's valuable because it kind of covers every stage of life or every stage of an investor's concerns, I guess you could say. So Charlie Munger, who RIP, he's Warren Buffett's partner. Warren Buffett and Charlie were very adamant about how the average investor, which is you, okay, unless you got $20 million, well, we'll say 10 million. You're an average investor. And I know that stings. Nobody wants to hear that. But if you have less than $10 million to invest, you're an average investor. And what I mean by that is you don't need anything special. You don't need any of this universal life insurance, these REITs, these 1031 exchanges. You don't need any of that stuff. Now, you can have it, and it does have its place in certain situations, of course. But generally speaking, you don't need anything fancy. Okay, and Warren and Charlie both talk about this. You need the S&P 500. If 80% of your investable money is in the S&P 500, you will be successful. Okay, you just will be. I'll dive into this later about why that is the case. And honestly, this might even be breaking SEC rules, me telling you this, because pretty much they consider the S&P 500 to be risky. All stocks, very, very risky portfolio. They would probably argue that's a 9 out of 10. They might even say 10 out of 10 risky. I personally here and at our firm, 5 out of 10. It's the bare minimum, the basic investment. Okay. The reason for that, 50-4-10, this great ratio. If you can't handle, and this is coming directly from Charlie, a 50% drop in your portfolio at any given time. If you see 50% drop and you sell, can't be in stocks. Can't be invested. You can't handle it. It's not for you. Okay? That's that 50% drop. You have to be able to come to terms with this money is going to be volatile. And there's a chance 50% of it could disappear in a day. Okay? But guess what happens within 2 years of almost every single market drop? It's back to where it was and then some. Okay, that's that 50%. So 50-4-10, 50. If you can't handle a 50% drop, can't be invested in stocks, stop doing it. The 4%, that's your withdrawal number. Okay, if you're thinking about retirement and not like, oh, I'm 65, I'm thinking about retiring. You could be 45 and have $5 million and you're not wanting to work anymore. Okay, you could be 30, same thing. Doesn't really matter. It matters about how much money you want your portfolio to create. The 4% rule states that if you can draw 4% and live off of it, you can retire. That's a great income amount that we can probably create for you guaranteed. And when I say probably guaranteed, I don't actually mean guaranteed. I mean kind of guaranteed. So a range of like 4 to 7. If you can live off of 4 to 7% of your portfolio, you can consider retirement. And the reason for that is because we can probably create that withdrawal number for you with never touching the actual principal. So for example, if you had $10 million, we could probably get you 400 grand, no problem. And you'd never go under $10 million. That's that 4% number. So 50% is your ability to handle volatility. That 4% is an income that we want to create off your portfolio. And then that 10% is that cash. Okay, you should never have 100% of your investable net worth invested. You should always, always, always have at least 10%. Some client cases I have 15, very few I have 20, because there's going to be downturns. More than 3 times a year, the S&P 500 drops 5%. Okay, if we can pump that cash into those downturns, you're going to get significantly more return, especially if you have a long time horizon. So 50, 4, 10. 50% is the amount you have to be able to deal with not seeing in the account at any given time. 4% is the amount we're looking to live off of. And 10% is the amount of cash you should always have in case of opportunity. Okay, the 54-10. I made that up. That's a James thing. You can take that to the bank. Okay, all right, let's read the news. And then I want to talk a little bit about, I had a LinkedIn fight that I kind of want to talk about on here. And then I want to talk about Vanguard, JP Morgan, and some other stupid bank who they're trying to tell us bonds are going to do better for the next 9 years or 8 years. I think it was 2034. So if you count 2026 till then, it's 8 years. But okay, let's read the news real quick. What to expect in markets this week. Last week, a market shift in comments from Federal Reserve officials suggested interest rate cuts could be coming sooner rather than later after a weak jobs report. This week, inflation could take the spotlight with fresh data due that could influence the position, which we are, remember, head is bowed, fingers are crossed, hands are in praying position, whatever. Hands are folded. That's what I was looking for. Okay. Scheduled earnings from a number of tech companies, including network giant Cisco Systems and NVIDIA-backed CoreWeave, could also offer more insight into AI infrastructure spending and developments in the cryptocurrency industry. Stablecoin issuer Circle has expected report coming in as U.S. legislation offers greater regulatory clarity has boosted cryptocurrencies. Let's see. Market watchers will get an update on inflation with Tuesday's expected release of Consumer Price Index for July after recent reports indicated price pressures are ticking higher in the wake of Trump's tariffs, including a higher June CPI reading. Now that is true because tariffs, you don't really know. Tariffs, you'll never really feel a tariff until way later. We're talking a year and a half. And by that point, the tariffs deal might have already been done, right? Like we might already have had a new deal with China. Well, that doesn't matter because the damage from the 6 months of waiting for that deal to happen is already done. It's already counted into the market. Okay, wholesale inflation data is set to come 2 days later, plus the planning Friday release of consumer sentiment survey results could show how the public views inflationary pressures. Fed officials will be watching the data closely as they look ahead to their September meeting, where some members will likely be pushing for the central bank to cut rates for the first time this year. Richmond Fed President Tom Barkin, Chicago Fed President Austan Goolsbee, and Atlanta Fed President Raphael Bostic could offer more clarity when they deliver marks this week. Cisco's earnings set for Wednesday come after the network equipment maker reported strong results for their prior quarter on the back of rising AI infrastructure demand, helping to drive its revenue higher. Cloud computing firm CoreWeave, a partner to chipmaker NVIDIA, is also scheduled to report its second quarter earnings just as its stock reportedly got a boost after CoreWeave said it would invest $6 billion in a Pennsylvania data center. Others set to report earnings this week include semiconductor equipment maker Applied Materials, ticker AMAT, nuclear energy provider Oklo, OKLO, and construction equipment maker Deere, DE, and restaurant chain Cava, CAVA. Okay, that's all I want to talk about in the news. Anyways, we got some big earnings this week. Cava's a fun one just because that was a part of our portfolio last year. Has not done well this year. I actually just traded probably the most aggressive portfolio in our book of business. Had Kava, I sold it. I just sold it. Kava had gone down 50% from where we wanted it to be. We were killing it. The client was still up, 75%. So it wasn't that big of a deal that we sold that, but I thought about waiting, and then I just said, no, let's just sell it, get it out of the way, capture those losses so we could pass those through. Big earnings, okay? NVIDIA, you see CoreWeave, that's probably the biggest one I'm going to be looking at. NVIDIA gives earnings, I think, August 27th, maybe 28th, somewhere around there. Expectations is the stock's going to shoot over 200. Nothing stopping the NVIDIA giant, nothing. And if you don't have NVIDIA individual shares, I think you're missing out on consistency in one of the biggest companies in the history of the world. I was trying to think right there of how I could say this without being hyperbolic, but then that's what I came up with. So, those are the big things for this week, right? Circle's a big deal. I don't really know what Circle's going to do. I mean, it's a stable coin company. I'm not entirely sure how they make money, and I haven't really looked. So to give you a full transparency description there, I don't really know. Okay, but I do want to talk about this LinkedIn fight I'm having. You know what I've learned about LinkedIn, guys? I own the business, right? I'm the guy. Brandon and I, we're the guys. Nobody can tell us what to do. Even each other, we don't tell each other what to do. It's a discussion. Everybody on LinkedIn that I'm seeing, they speak, it's like fake Facebook. At least in Facebook, you get to be a jerk to somebody. You get to try to be funny. On LinkedIn, it's like professional, I don't even passive aggressiveness. Professional passive aggressiveness. I hate it. I hate everything about it. But it's important as a business owner to be on there. So when I'm on there and I'm seeing these people have these posts, the whole time I'm just like, what are you talking about? Why don't you have a single independent thought for yourself? So let me read this, and then I'll read what I said to this guy, and we'll sort of explain. And this all, again, comes back into the 5410 argument or situation or discussion. Okay, so this is some guy, I won't gaslight him, but his name's Jordan, and he is a CFP. Okay, CFP is part of the mountaintop of great designations. Okay, you have CPA, CFP, CFA, CIMA, CPWA, pretty much everything else. Even the current designation I have, CRPC, it's way down the totem pole. It's just not, like, to be a CFP and have these opinions blows my mind. But then again, I think CFP is the weakest. Weakest is probably not the right term, especially because Brandon's about to get to CFP. It's very, very important. CFP is a great sales tool and planning tool. So I'll say that. As far as being a trailblazer and having your own opinions, there's not a lot of CFP coming up with equations and coming up with calculations and investment ideas. In fact, I'd argue there's none. So CFP is great about learning the rules, how they are, and then offering value within that system. But to create something new, I've never met a CFP who is independently thinking. So, and again, that's probably so mean, but it is what it is. Okay, so this guy, Jordan, who's a CFP, said this. For my thrift saving plan, folks, I've been seeing a lot of posts lately about how you should be putting 100% of your money into the C fund, aka the S&P 500 fund. While the C fund has had a great run, it's important to be very cautious with this advice. Here are a few things to consider before you go all in. Past performance is not a guarantee. As disclosures always say, yesterday's returns don't predict tomorrow's. Markets are cyclical, and no one knows which asset classes will lead the pack in the next decade. Remember, there have been many periods where small-cap stocks have outperformed the S&P 500. Concentration risky, which is a typo by him. He meant to say concentration risk. The C fund is heavily weighted towards a handful of massive companies. Roughly 38% of the S&P 500's value is concentrated in just the top 10 companies, mostly tech companies. This means a significant portion of your investment is riding on the success of just a few names. This means your future is riding on the success of just a few names. He literally just said this. So hold on, let me read this again. This means a significant portion of your investment is riding on the success of just a few names, period. This means your future is riding on the success of just a few names, leaving you more exposed if that sector faces a downturn. Crazy that he wrote it this way. Your strategy should be personal. The best investment plan is one tailored for your goals, timeline, and risk tolerance, not a generic one you see online. Ultimately, your TSP is a key part of your financial future. Let's make sure it's working for you in a way that feels right. If you're a TSP investor and this is you thinking, I'm here to help. Okay. My blood is boiling. I'm enraged right now. If I had 55 drinks before this or 10 beers, I'd be sober because my adrenaline would be boiling at the top of my head here. This is terrible advice. Okay, terrible advice. The S&P 500 is the most stable, consistent investment you can be in. And if anybody tells you different, they're trying to sell you something. Stop listening to them. Okay, yes, we pick individual equities here, but that's because we do our research. Okay, and we're long-term investors. I'm not trying to day trade stuff. We held Kava for over a year. That went down 50%. We held Novo Nordisk for over a year. That went down 75%. Okay, now luckily we have a lot of great winners, right? Palantir, SoundHound, Costco, EAT, AT&T. We have a whole bunch of winners and very few losers. But the point is that I'm trying to say, you don't even need someone like me, and you certainly don't need someone like Jordan here. Okay, if you have more than 5 years left in working, you don't need anybody. Just put it in the S&P 500 and wait. Now, if you want somebody like us to try to do a little bit better than the S&P, which averages 10.5%, by the way, then yeah, there's value in that. But this guy is trying to sell a financial plan, a $2,000 to $10,000 financial plan to diversify you out of the S&P 500, which is going to get you less return than the S&P 500. Okay, 95% of money managers cannot beat the S&P. It's just the truth. Okay, and I think it's even more. I think it's like 98% of retail investors don't make money. They make zero money. They lose money. So there's value in having an advisor, and then there's value in being in the S&P 500. If you have someone who does not manage their own money, okay, we manage our own money. There's no other hands in the pot. It's me and Brandon. That's it. He does the taxes. I do the investments. Nobody else. All of these other firms, this Jordan guy included, they don't want to be making these investment choices. They don't want the responsibility of a 50% drop. Okay, they don't want that. They want your money and then to diversify you out of risk, which is out of reward, essentially, and then pay a third-party money manager. They're called TAMPs, Turnkey Asset Money Programs. Turnkey Asset Management Programs. Sorry, it's been so long since I've even seen the acronym. Your advisor's probably using them. If you have a financial advisor, you need to ask them if they use TAMPs. Do you have a third-party money manager? And their explanation, if they do, their explanation will be, well, yeah, but I'm not picking stocks. That's not my wheelhouse. But they're making money off of your stocks, off of your investments. You are likely paying someone 1% to not pick your stocks. Okay, and then you're paying probably 0.5% to the TAMP to pick your stocks. So now you're paying 1.5%. Which over 30 years, especially if you are a decent earner, that's hundreds of thousands of dollars, if not millions. So please, learn who's investing your money. Also, if you're doing it yourself, there's nothing wrong with that. I like that. I would rather you do it yourself than work with someone like Jordan, who is, oh, well, we don't really know what's going to happen. Yes, we do. We do know what's going to happen. You want to know why? Because the S&P 500 makes up 40% of the global equity market. 40%. If you're in emerging markets or international markets and the S&P 500 crumbles, falls, your entire portfolio is going to fall too. Everything is going to fall. If you take 40% out of any building, that building is going to fall. Okay, it's like Jenga. Take away 40% of the little bricks. That thing's gonna fall. So stop listening to these people use fear which this guy, Jordan, is using fear. It's just not true. Why not invest in 80% of your portfolio, which maybe I should make the 54-10, 54-10-80. Maybe I should change it to that. But 80% of your portfolio in the S&P 500, there's probably nothing you could do with that 20%, even if it went to zero, that would prevent you from getting a good rate of return on your overall portfolio, because 80% of it is in the consistent 10.5% return S&P 500. Okay. Oh, I get heated about that, but I mean, 40% of the global equity is the S&P 500. There is nothing you could really invest in where you're like, okay, well, I want to take some risk internationally that doesn't get affected by the S&P 500. The S&P 500 is weaved into everything. Everything. Anybody who tells you different, they don't know what they're talking about. I'm way over 15 minutes, but I hope you guys learned something today. 54-10. Don't forget it. And as always, invest early, invest often. We'll see you next week.